Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Bristol-Myers Squibb stock so we can determine if it's a buy or a sell. BMY is one of the world's largest pharmaceutical companies. It manufactures prescription pharmaceuticals and biologics in several therapeutic areas, including HIV/AIDS, cardiovascular disease, diabetes, hepatitis, rheumatoid arthritis, and psychiatric disorders. The company is headquartered in New York, New York, and was founded in 1887. Let's get started with the model. This is a large cap company, 144 billion market cap. They're trading at $68 a share, and they have 2.1 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow doubled from 2019 to 2021, over 15 billion. It did drop from 15 billion in 2021 to 12 billion in 2022. But still, 12 billion is a huge number. Net income is the profit or loss on the income statement. It's revenue minus expenses. They had a big negative in 2020 due to a lot of write-downs. When you see a big negative in net income while a company has positive free cash flow, it's almost always asset impairments. That's when you decrease the value of an asset on your balance sheet and pass through the loss onto your income statement. The main culprits for asset impairments are goodwill impairment and physical assets like a building or a piece of machinery. It turned positive again in 2021 at 7 billion, then 6 billion in 2022. Revenue is a sales for the company, and that grew a lot from 2019 to 2020. Then it's been pretty steady after that, growing a little bit from 42 billion to 46 billion. They recently released their first quarter 2023 earnings, and this is their income statement. They had revenue of 11 billion, which is pretty much the same as 2022. I'll give you a breakdown of this 11 billion. Of the 11 billion, 8 billion is in the US, 3 billion international. Their drugs are sold all over the world. They only generate 700 million from new products. Their main products are 8.6 billion of revenue. One of their cash cow drugs, Revlimid, is an LOE, loss of exclusivity. Revenue went down from 2.8 billion to 1.8 billion. I'll give you an example of what this means. When BMY patented Revlimid, the patent doesn't last forever. It usually lasts for about 10 or 15 years. That means BMY has exclusive rights to selling this drug. When the patent expires, they could still sell the drug, but other companies can sell generic versions of the drug for a lot cheaper. So they'll still get sales from people who want to buy the regular original drug, but there's going to be plenty of people who are willing to pay for the generic version because it's cheaper, and it pretty much does the same thing. Their big money maker now is Eliquis, 3.4 billion. Which is about 30% of the company's revenue. Let me show you what Eliquis is. Eliquis is used to help people reduce their risk of stroke and systemic embolisms. Revenue for this drug increased 19% in the first quarter from higher demand and to a lesser extent higher average selling price. Although international sales decreased 18%, mainly due to erosion in Canada and the UK. It looks like starting in May 2021, they lost exclusivity in Europe. Below revenue is the cost of revenue. These are all the expenses directly related to generating the revenue. That was 2.6 billion. That's the cost to make the product. Then you have marketing, 1.8 billion, down a little from last year. R&D, 2.3 billion, similar to last year. Acquired in-process research and development, 75 million. That's when they acquire companies that are in the middle of research and development. Amortization, 2.3 billion. So total expenses, 8.6 billion. Taxes, $500 million. Net income, 2.3 billion, up a lot from last year of 1.3 billion. So their earnings per share went up from 60 cents to $1.08. Let's look at the capital structure. 31 billion of equity, 41 billion of debt. They're 43% equity, 57% debt. Their net debt is 32 billion. So they have about $9 billion of cash on their balance sheet. I gave them a WACC of 9.3%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $220 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $202 billion. We divide that by 2.1 billion shares, and we get a calculated stock price of $96. They're trading at $68. They're trading at a 29% discount. It's a strong buy according to the model. Simply Wall Street's really high on this one, 169. They say the stock is 60% undervalued. 8 analysts priced this stock, and the average price target is 75. The low is 59, the high is 92. 21 analysts priced this stock, and the average price target is 79. They say the stock is 16% undervalued. This is where the stock has been trading from 1981 to 2002. It had a pretty slow and steady growth from 1981 to 1992. It broke through $20 in 1991. Then it started declining in 92 and 93. It bottomed out in 94. Then it had a huge run up. It went from about $15 in 94 to $80 in 99. It couldn't really sustain these levels, so it dropped below $50 the following year. Then peaked again at 70. Then the dot-com crash. It came way down below 30 to around 25 in 2002. And throughout 2002, it kept declining to around the low 20s. It traded sideways from 2002 to 2007. Then the Great Recession hit, and it dropped below $20. Then the big bull run from 2009 up through 2016. It broke through $70 again. And right before COVID, it was 65. It dropped below 50. And then in mid-2022, it ran up past 80, its highest ever. It has come down about 15-20% from that peak to below 70. And that's where it's sitting right now. They pay a quarterly dividend that they raise each quarter from 40 cents to 57 cents, a yield of 3.35%, which is 40% of their free cash flow, 76% of their net income. There are 15 companies in the same industry as BMY, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend a good amount of capex, $1.1 billion. Their debt-to-equity ratio is worse than the median, better than the average. Their yield is a little worse than the median. They generate more free cash flow than the average and median. Their market cap is the median since they're the 8th company on this list out of 15, which is exactly in the middle. They have really good price multiples. Price to book a lot better than the average, a little better than the median. Their PE is better than the average, equal to the median. Really good price to free cash flows. Great price to sales ratio. They generate lots of revenue, $46 billion. And they're growing more than any other company on this list, except for the tiny Horizon Therapeutics. Their 5-year annual revenue growth rate is 17%. To summarize, I have them trading at a 29% discount. They've been around 136 years. They're really stable, dividend-paying, solid company. So it seems like a good long-term hold, pretty safe. I rank their free cash flows 4 out of 10, their revenue 6 out of 10, and their ratios 8 out of 10. So let me know what you think. Give the video a like, subscribe, or comment below. If you want to be a member, click on the link in the description below. Thanks for watching.